Hello, and welcome to another episode of Getting Your Shit Together, the podcast that helps you navigate the world of mortgages, real estate, and smart financial decisions. I'm your host, Neil, and today we're kicking off with some major updates from the Bank of Canada that could impact your mortgage and overall financial strategy. Earlier this week, the Bank of Canada delivered another quarter point rate cut. This is the sixth consecutive rate cut since mid of 2024, dropping the prime rate to 5.20%. So that's a full 2% decrease from where we started last year. So if you have a variable rate mortgage or a loan, this means even more relief with lower interest cost as we head into the new year. For fixed rate mortgage holders, nothing much changes. Your rates remain as is. But if you're looking to buy or renew your mortgage, this could be great news. So let's break this down a bit. Since June 2024, borrowers have saved about $166 for every $100,000 of debt in monthly interest cost. So that's some serious savings and relief for a lot of people for the cash flow. Now, if you're the curious kind, you might wonder why Bank of Canada made this move. And so let's look at some of the economic trends driving these decisions. So the biggest factor behind rate cuts, yeah, inflation. As of December 2024, inflation in Canada has dropped below the Bank of Canada's 2% target rate. The reading in November was 1.90, and December was even low at 1.80%. So all good on that front. But at the same time, Canada's GDP has been sluggish, with just a projected 0.1% decline in November. Lower inflation combined with weak economic growth puts pressure on Bank of Canada to keep rates lower in order to stimulate spending and investments. Now, how about the job market? Well, the job market remains a mixed bag. 91,000 jobs were added in December, so that's great news. But unemployment is still high at 6.70%. So while this suggests some stability, the overall economy is still moving slowly, reinforcing the need for lower interest rates. But here is a twist. We have to look at what's happening in the US, and that's not helping our cause. The US economy is playing a big role in Canada's rate decisions. US unemployment remains low at just 4.1%, near to the record lows. Inflation is creeping back up. It was at 2.90% in December and moving sideways. Q3 GDP growth exceeded expectations at 3.10%. So way faster growth rates than we are seeing in Canada. So these risks ahead, combined with the proposed US tax cuts and possible tariffs in Canada, yeah, this could keep inflation high in the US, influencing how Bank of Canada handles future rate cuts is a mystery, even to the bank. They were not confident as to where these things could move between now and maybe even their next meeting in March. So something to watch out for. So how does all of this impact your mortgage? That's a question you might be asking. Okay, let's review in detail. So first up, let's review what is happening with bond yields and fixed rate mortgages. Well, bond yields have stabilized, and the spread between the bond yields and the fixed rate have returned to sort of historical norms. So that means fixed rates are becoming more predictable. They haven't really moved anywhere since November of 2024, maybe inched up slightly, but they're pretty much no movement in that front. As the market activity increases, that means as more and more people renew and maybe buy or refinance, you can expect mortgage rates to remain competitive with the lenders, unless there is some economic uncertainty and hence maybe a drop or an increase in the yields. How about a fixed and how does it compare to the variable rate trends? Well, the gap between fixed and the variable rate mortgages have been narrowing. You could see some variable rates which are pretty close to fixed rates, not yet matching or below fixed rates, but still coming closer. And we could see that happening in the months. This could bring back the traditional pattern where variable rate mortgages tend to be available under their fixed rate counterparts. So that could be some good news for people who are more comfortable with variable rate mortgages. But there is a catch here. What we have been seeing is that lenders have not been offering great discounts. The discounts have actually come down by 20 to 30 basis points in the last couple of months. So something to watch out for. So what should you do if you're looking to either buy, refinance, or renew your mortgage? Well, my advice would be if financial stability is your top priority, and if you feel that you're not in the top condition as far as finances are considered, I would recommend a fixed rate mortgage as it is a much safer bet in terms of at least price stability or payment stability. Right now, 3 to 5 year mortgages are aligned with historical averages, making them very attractive choice. If you are comfortable with some risk, variable rate could still work, but keep in mind the discounts are shrinking and the future savings depend on how many cuts are there from Bank of Canada, or maybe even if there are rate increases. So the risk is to the upside. So unless you really are comfortable taking that risk, I would say avoid it. So what's the bottom line? Well, if you have a mortgage or are thinking about getting one or in the process of renewing your mortgage, now is the time to review your strategy. The rate cut cycle is in full swing as of today, but how you could take advantage of it depends on your financial goals. If you're unsure which mortgage option is best for you, let's connect. Whether looking to refinance, purchase, or just optimize your payments, having the right strategy in place will help you make the most in 2025 and beyond. For the next topic of this podcast, let's talk about housing affordability and how this and where we stand today. So as we enter 2025, housing affordability in the Greater Toronto Area obviously continues to be a major concern. I have been analyzing market trends for the last 10 months, and based on the December sales figures across 65 plus neighborhoods and 4 property types, I can give you a picture of where things stand today. So, key insights that I could gather are out of the 292 tracked property type and location combinations, about 124 saw price increases, so roughly half of them. Detached and semi-detached homes had the most significant growth in terms of prices, both year on year as well as month over month, so November to December. Affordability challenges obviously persist. So the slight rise in fixed rate mortgages since November of 2024 have made the affordability tougher or the income requirements a bit higher in 222 out of the 268 property type location combinations that we track month over month. Now, this does not factor in the relief that the first-time home buyers have started benefiting from the mid of December. So these are in terms of lower down payment requirements and access to 30-year amortizations. So that is going to alleviate some of these concerns, but not by much. Income requirements still remain very high. Detached homes, obviously the most desired property type, continues to be the least affordable option, especially for buyers with a 5% down payment or close to that. Cities like Oakville, Aurora, King, Markham, Richmond Hill, Vaughan, and much of central Toronto are out of reach for these kinds of buyers. But Durham region remains a solid choice for first-time home buyers looking to get into the detached home market. So check out our latest report for all these details. Use this to zero in on which locations would suit your budget. Link in the description. Okay, so let's now head into the last segment of today's podcast, and we will center on smart tax strategies that real estate investors and homeowners renting out a part of their home property can make use of. Now, disclaimer here is I'm not a tax expert, but I have personally benefited from these strategies, and so it could help you too. Be sure to consult a tax professional for advice tailored to your situation. So, with that, let's look at a few of them. So, first up is deductible expenses. Keep track of all your expenses related to your rental property because it's a business, right? You need to know how much you spend on repairs, utilities, mortgage interest, and anything else that might be tax deductible. This could reduce your taxable income, overall taxable income, and thereby the total taxes that you need to pay on a personal basis. So you might even get a big tax refund if you approach this smartly. Next up is smart refinancing. And what I call smart is because there is little value in having too much equity tied into the property because that doesn't do anything for you. So if you are borrowing some of the equity that you have in either your personal home or a rental property or investment property and use it for investments, the interest on that borrowing could be tax deductible. The interest could help in lowering your taxable income and thereby saving your taxes, and you have more money to invest. Next up is prepaying some of those expenses. If you're able to shift some of those expenses into such a year, then you could be reducing your tax liability. Again, consult with a tax accountant and they would be able to guide you more, but that's a strategy. Obviously, leverage any tax credits. So that could be government incentives such as energy efficiency rebates. Those could be interest-free loans that you get for green home, putting on solar panels on your roof. Those could be strategies that you could use to increase the value of your investments, but also at the same time get some tax relief or or cash flow relief. So again, investigate those. There are obviously some pros and cons involved in such schemes, but again, use it where it is advantageous. Selling your property in a lower income tax year or wherein you have a lower income as compared to others can help manage some of those capital gain taxes, right? Another thing to watch out for is obviously CRA is still charging the higher tax rate or the higher capital gains tax even though that is not a law. So if you're able to avoid selling a property or realizing capital gains while that issue is now still being sorted out, then your money might not get stuck. Using rental losses. Now, having losses on your rental income is never a good idea, and you should really evaluate whether that is something that you want to consistently keep doing. But if that is one off, then obviously use the losses to reduce your income or taxable income because it offsets any other income types as well. And so that could be advantageous in a year where you have an occasional rental loss. Now, I know a lot of you out there have condos and maybe your cash flow on those are negative. But again, this is something that you could use to reduce your overall tax rate or taxable income. Now, lastly, there are some tax deferral strategies. If you are able to defer your income or it could be capital gains or a gain on sale of a property, over multiple years, then it is a useful way to manage your tax burden over time. And these could be typically where you are selling a big asset and maybe you have a BTB or some other strategy of that sort where you're not realizing all the gains at once. So these could still help you minimize your tax burden and spread it over time. You also have capital cost allowance. Now, these help you to deduct depreciation on your property over time to balance the maintenance cost against the taxable income. Now, this doesn't help you avoid taxes because that would eventually be added back to the adjusted cost base when you sell the property. But you get to get some relief while you're holding onto that property over its lifetime. These are just a few strategies that can help real estate investors and homeowners renting out part of their home maximize their returns. I would suggest diving deeper into these with your tax consultant and take full advantage of any benefits that might be available. So that's it for today's episode. Don't forget to subscribe. And if you found this useful, share it with someone who might want to hear this. Well, until next time, keep getting your shit together.